Welcome. Safe stock investing requires constant exploration of opportunities that are hidden gems. Being a cautious investor myself, who prefers safety over reckless investing, I try to understand the humming going around suggesting exploring global investment opportunities, be it stocks, ETFs, index, etc. We will try to understand some of the nuances of this assumption. Well, in today's interconnected world, investing only in domestic market limits growth. Global indexed investing offers diversification, access to global innovation, and a natural hedge against currency depreciation. Over time, such exposure builds resilience and enhances long term results. Global indices not only diversify risk but also unlocks opportunities across innovation, technology, and luxury section. With the rupee's steady depreciation, return from USD and euro assets often outpace domestic indices, making global allocation both defensive and strategic. Global indices mirrors the pulse of the world's leading economies, from the S&P 500 symbolizing US innovation to India's Nifty 50 and Europe's STOXX 50 consisting of blue chip companies. They act as powerful benchmarks for diversification, helping investors balance both domestic and international exposure. Over time, currency shifts, especially the rupee's depreciation against the dollar and euro, have further amplified INR return from the global market. In today's deeply interconnected world, tracking global indices isn't optimal anymore. It is essential for building a resilient and future ready portfolio. Here we will compare India's Nifty 50 and Sensex with America's S&P 500 and Dow Jones. Despite India's strong growth, the S&P 500 showed comparable or higher INR-adjusted returns due to consistent performance and rupees depreciation against the dollar. The data underscores why US exposure strengthens portfolios. Similarly, Europe's STOXX 50, comprising top blue chip companies, has shown solid INR adjusted performance. Over the past 5 years, INR weakened roughly 21% against the euro, giving Indian investors an added currency advantage on top of stable European growth. Over the years, the Indian rupee has steadily depreciated about 3 to 4% annually against major currencies like the USD and the euro. This gradual decline means that every dollar or euro earned through global investment converts into more rupee over time. So when you invest in international indices such as the S&P 500 or the STOXX 50, you do not only benefit from the market's own growth, but also from the currency appreciation effect. In simple terms, a weakening rupee adds an extra layer of return for long-term global investors. You can see for yourself that over the last decade, up to January 25, the Indian rupee has steadily depreciated against both the US dollar and the euro. This depreciation, averaging around 3 to 4% annually, has translated into additional return for Indian investors. Stocks 550 or even the Hang Seng Index, all of which have appreciated strongly in 2025. The currency effect has been the icing on the cake, magnifying INR return. Of course, if the rupee appreciates in the future, this arithmetic will undergo change, might reverse as well. We'll explore the mechanics of currency fluctuation and its broader economic impact separately. I earnestly urge the viewers to kindly peruse the disclaimer carefully. Many viewers would be wondering how to trade in global stocks, indices, ETFs, etc. I will cover the same in part 2 of this presentation if you all wish to understand the mechanics of global investing. Please like, share, comment, and subscribe to my YouTube and Instagram channel mentioned to encourage me to prepare for insightful videos on investment and wealth creation. Thank you so much.